Good afternoon, everyone. I'm really glad to have you all here for an exciting panel about inclusive banking. So the topic of our this afternoon's banking is development of inclusive banking services across Asia. My name is Tom Ludescher. I'm the chairman of the Swiss Chamber of Commerce and Industry in Singapore. I'm also the vice president of the European Chamber of Commerce and Industry, and I'm a tech entrepreneur and investor by myself. I have spent most of my life in corporate insurance and then made some time ago the big step from incumbent into technology, and that's also what I'm most passionate about, is this link between existing financial services players and technology firms, and I think we have a wonderful panel today that is perfectly addressing this. So let me start with a quick story. I met yesterday evening at the bar, I met a friend, a Horace's friend, and he told me, Tom, and he already had 1 or 2 beers, and then I said, well, what is? And he said, Tom, there is something wrong with your panel. I said, well, what is wrong with my panel? And then he said, well, Tom, you're Swiss. And then I said, well, what is wrong about being Swiss? And then my friend told me, listen, Swiss banking is not inclusive banking, it's exclusive banking. Then I said, well, my dear friend, you're right, but you're also wrong. And why is he right and wrong? He's right because the private banking, as we know it also here in Asia, is something which is very elitary. It's only open, of course, for the high net worth individuals. It's an old business. It's in Switzerland, it's older than 200 years, so that's one of the oldest banking businesses in the world. But at the same time, a few decades later, around 150 years back, this was during the time of the industrialization, you had a credit squeeze for small businesses, and you had a credit squeeze as well for farmers. And so this is something which may sound very familiar to you, because these are situations that we also encounter here across the region. And so how was this 150 years ago addressed? It was addressed on the one side by a private initiative. So there were private individuals standing together and opening up a cooperative bank. And this cooperative bank was then basically getting all the savings in and lending to the ones that otherwise were not able to access credits because the greater banks were just not caring about them. So this is a 150-year-old example of inclusive banking. You had at the same time, you had a state initiative in Switzerland. Switzerland is a small country, but for the ones that would know it, would know there are 26 different states, and these 26 different states ended up 150 years ago with having one state bank each, and these state banks were doing exactly the same. They were making sure that there is no credit squeeze for farmers, for small and medium enterprises. And this is for me a perfect example that certain needs in the markets, they never change, they're always there. The question is just how do you serve them? And I think today we are in a very exciting time that we can serve them much better with technology. Technology is for me the catalyst that really allows to transform otherwise non-inclusive financial service, cost efficient and agile, to the ones that need to tap on it. And the question is for us now, how big is this issue about the unbanked? I mean, is this just something that is being made big in the press, or is this something which is a serious issue? And it is a serious issue. When you have followed recently the IMF meeting in Bali, Christine Lagarde, she mentioned a number, 1.7 billion. 1.7 billion adults on this planet are unbanked. That's a big number. And of these 1.7 billion people, more than 400 million are unbanked in Southeast Asia. So that's also a massive number. So we see in Southeast Asia particularly, we are dealing with unbanked rates of above 70%. And they go up to 95%, for instance, in the rural Cambodia. In some a bit more developed markets, there, of course, they are closer to 50%, but nonetheless, this is still a very, very large number, and this is a number that must be tapped on, because if you give people access to credits, if you give people access to payments, this is usually the start of becoming more wealthy, of running your own business, having less unemployment, and finally having also an economical growth that is above the average that you would otherwise see if you have these sort of credit squeezes. And so what struck me was having more than 70% without a bank account, but in the same region you have 75% of the people having a mobile phone. So you see that there's a big mismatch between technology and financial services. And that's probably one of the biggest points today that we are going to address with the panel. I mean, for Southeast Asia, this will be the main focus today. Nonetheless, I would like to mention first a very good example also from the region, which is China. When you see what happened in China today, you have 700 million Alipay accounts. You have 800 million WeChat Pay accounts. I mean, these are massive numbers. And you know that 5 years ago, this looked completely different. And this is for me an indicator also what is going to come here in Southeast Asia. If we see a similar pattern like in China, then this will make all these markets here digitally absolutely leapfrogging, plus, of course, financial inclusion-wise, to close to a big extent that gap. And parts of the gap are clearly technology-driven, but also other parts are more cultural-driven, and these are also some of the points we want to address today with this panel. So, without further ado, let me introduce here this wonderful panel of experts that we have here. I would say we have the movers and the shakers in inclusive banking here present. It's a very special panel because it's not a panel that mixes policymakers, incumbents, and tech players. This is really a tech panel, and everyone here being part of that panel is working every day into making Southeast Asia more digital and banking more inclusive. And I think when we can learn today from these panelists about their passion, what is driving them, and also so far still what is holding them back to succeed even faster. So this is for me the main focus that I want to learn out of today's panel. It should not only be a panel discussion, please, from the audience, when you have questions, there will be enough time in the second part of our panel discussion when you can ask these people, these experts, about their own real life experience in working in inclusive banking. So with this, I open up our panel discussion. I would like to first start our panelists and give a quick introduction about themselves, and also say what you're passionate about and what is driving you. Maybe we start on my left side with Adrian.
Thank you, Tom. So I'm the CEO of GoBear. A little bit about GoBear. We are a financial supermarket. We are the best funded financial supermarket in Southeast Asia. We have roughly 35 million visitors. We're across 7 countries. We have over 1,500 products on our supermarket shelves, and we have well over 100 partners. What I'm passionate about is transforming financial services here in Asia. I think for us at GoBear, we are more tech in terms of being friendly to consumer, in terms of user experience, than the traditional financial services incumbents, and we are more financial than a typical tech company, which may be very focused on social media engagement and so on. So I really believe that here at GoBear we will be able to make a massive difference to help people improve their financial health in the region. Thank you.
Hi, good afternoon. My name's Miko Perez. I'm the founder. Good afternoon. My name's Miko Perez. I'm the founder and CEO of Ayana. We provide affordable and accessible digital financial services to what I call the emerging middle class, primarily here in Southeast Asia. So we started in the Philippines, and in the Philippines, as probably some of you know, there's a huge remittance market. So that was the first use case that we started with. We are making cash remittance. As Tom mentioned, a big portion of the Philippines economy is still in cash. I would say 99% is still cash. And so we started there by making cash remittances more affordable and accessible. So right now, since 2015, we have one of the largest, if not the largest, domestic remittance networks in the Philippines. The domestic remittance industry in the Philippines is huge. A lot of foreigners don't know, but it's actually a $60 billion in terms of principal conveyed industry. And this does not include the $31 billion that comes into the Philippines from all over the world. So we started out with building a remittance network, and it's also a payment network where people can actually transact. So since the Philippines is still pretty much a unbanked market, I would say only around 12% of Filipinos are already banked or carded, we had to start with what I would call an agent-based model or a click-and-mortar model where we are addressing customers where they are. So many of them are still accustomed to transacting over the counter, but we're slowly moving them to what we call an omni-channel sort of engagement model where we can engage them both either over the counter through our network of agents, or we can engage them over the phone or over the web. So we built out this omni-channel sort of engagement model to address this broad middle class. Now, as the payment infrastructure is being built out, we're now introducing more products. So we started a credit scoring system in the Philippines recently. Again, the Philippines has no credit scoring system addressing the broad segment of the population, and we launched it. It's called Kaya Credit. In our language, Kaya means rich. In Bahasa Indonesia and Bahasa Malayu, Kaya also means someone who can afford, who is rich. So we're very excited about that. It's really a marketplace that brings together lenders from all over the world and also the incumbents within the Philippines, as well as the fintechs from all over the world, maybe including Alexi's companies, and allows them to reach those who want to borrow. And so far, since we launched it last September, the response has been very enthusiastic and sort of giving us sort of early lessons on how to engage customers, the unbanked, and also how to connect them to both traditional financial service providers and the challenging fintechs.
Kim Andrews, Nova Finance Group. We're a non-bank, we would be classified as a non-bank lender in Australia. Since 2004, we've been providing trade credit, debtor finance, invoice finance to SMEs in Australia. 99% of it's domestic work. The Australian banking system is very different from the rest of Asia. We've got a fairly, in some ways, well-developed legacy system. But I wanted to, we can come back to other things about what I do, but some of the things that Tom said in his introduction makes me want to share a story with you that is not part of my original notes. Some participation. Who's ever heard of Bank of America? Who knows what it was originally called? Spot on. I knew if there was anyone in the room that would know, you would know. If you doubt me, go to New York and look at the Bank of America building. It's called the J.P. Giannini building. Does anyone know the story of J.P. Giannini? He's spot on. His father was an immigrant, had a fruit farm in California, and he had an argument with one of his workers one day, and the worker pulled out a gun and shot his father in front of his son, who was about 6 years old. Mum sold up the farm, went to San Francisco, bought a boarding house and wanted to raise the children. Young JP was really interested in farming produce because that's what he'd seen as a young fellow, and he started working down the fisherman's market. And that big earthquake in the early 1900s hit San Francisco, and the banks got together and said, we'll have a 6-month banking holiday. No banks open for 6 months. The next day, young JP in his early 20s rolled down to Fisherman's Wharf, got a couple of wooden barrels on their end, and put a piece of timber across it and started banking, taking deposits and particularly lending money to farmers that he couldn't get elsewhere. And I was thinking as Tom was doing the introduction and talking about exclusive and inclusive banking in Switzerland, that sometimes you can see the future by looking backwards. And there was a massive unbanked population all of a sudden, but an entrepreneur made something out of it that became a well-known bank. We can talk a little bit more about some of the things we do and how it might fit in, but I think that was an interesting, that Tom's introduction was an interesting segue to the history of Bank of America.
Thank you. Tom?
Hello. I'm Thao. I'm from Myanmar. So we are focusing on corporate advisory business, M&A, corporate finance, and also investment management and monitoring, etc. So we have the same client in Myanmar. They are running banking business, insurance business, and other security business, etc. Myanmar, I have to say, quite new market now. and quite emerging market, but a lot of behind the other country among the ASEAN peer. So we have to take with the technology in the long run. So most of the people in Myanmar, they don't have the bank account. They have the only 40% might be 38%, 35% may have bank account. So more than 60% they don't have the bank account. So and also for the banking side, most of the banking business in Myanmar running traditionally. They are very human capital intensive. They haven't touched with any technology. So now painters and blockchain, etc., financial technologies are really quite competing the traditional financial institution. So I will share a bit about how Myanmar Bank and other traditional banking organizations will have impact from the emerging of the financial technology, etc. Thank you very much.
Thank you, Tom. Alexei?
Hi everyone, I'm Alexei Sidorov. Just a few words about my background. I'm currently a fintech entrepreneur, started a few companies, and before doing that I was a banker. I spent about 12 years in the banking industry, thank you. And I worked for Citigroup and also for a startup bank which was backed by Citigroup Venture Capital and EBRD, the European Bank for Reconstruction and Development. So in the 12-year history or a 12-year career that I had, I learned a lot about the problems that the banks have. And the reason I decided to quit, because I realized one thing. The banking system is quite broken. And I was not there to fix it because, you know, it's got a lot of legacy issues. Well, banks do serve millions or billions of people around the world, and they do add value to a lot of economies. However, there are still millions, hundreds of millions of customers around the world that cannot get banking services. So I thought, why not quit my job and actually start working on something that's more exciting, that could work faster, that could be cheaper and better meet the needs of a lot of customers that want to get banking services but cannot for whatever reason. So I originally come from Kazakhstan. That's where I built my first few businesses, and that's where I made my career. And we're very active in online financial marketplace, the same business model that GoBear and Wishfin are operating in this part of the world. We're also active in online lead generation and digital marketing. We run these marketing campaigns for the banks, so we help them get access to the customers online. And plus we also do lending ourselves. We've developed our own technology and credit scoring and lead generation algorithms, so we can actually, and also debt collection algorithms, so we can make more impact in terms of financial inclusion. And what makes me excited is really to be part of this huge mega trend, which is about the next 1 billion people getting online in the next 3 to 5 to 7 years, or maybe even faster than that. And majority of these people will likely be coming from Asia. And I'm talking about all Asia, including Central Asia, which I'm very familiar with, all the way to Southeast Asia. So that's what I'm hoping to be a part of in the next few years. And thanks for having me here.
Thank you, Alexei. Koyang?
Hi, Tom. Hi, everyone. How are you? I'm Ke Wang from Taiwan, and I'm the founder and chairman of the Taiwan FinTech Corporation, which we call Fusion 360. The reason we call it Fusion 360 was because we think FinTech is the fusion of financial and other industries, and 360 is the 360 degree of analysis that you need to analyze the data to enable the inclusive financial services. Because as Mr. Sidorov talked about, there are 2 billion people who are unbanked, and there are many SMEs who couldn't get support from the traditional financial institute. The biggest problem was because they don't have trustable credit history. So we are trying to use different kinds of data to help them to build this credit history. And the best way is to use the existing systems in different companies and also social networks to build those, and open data to build those history. I'm also the chairman of Taiwan FinTech Association, which we have more than 100 members. About 40% are actually financial institutes who are interested in implementing FinTech. And then we have 40% FinTech companies and then 20% academic and government officials. I'm also the co-founder of the blockchain and cryptocurrency self-regulating organization, because we believe that in order for the blockchain to be a stable, to be a game changer for the industry, the participants need to self-regulate before the regulatory body realize how to regulate this new industry. So we were actually one of the first SRO that came out with the exchange self-regulating code conducts. Yeah. And my company actually developed platform as a service solutions that integrate data and analytics together. So we are a B2B company. So we help financial institutes or fintech company or other companies to conditionally sharing their data and protect their data. Because I believe that in order to share data, the first thing you need to do is to protect the data so you can build the trust to share. Yeah. And we also have a private funding platform, a decentralized private funding platform to help the ICO teams, especially blockchain teams, to get private funding for STO, the security tokens offering. Okay, thank you.
Thank you.
Hi, this is Rishi. I represent a company called Wishfin. I'm a co-founder of Wishfin.com. We're basically based out of India. We help consumers make proper financial decisions through whenever they're looking to buy a personal financial product. So we are marketplace by nature, but what we do operate is that we help customers make proper financial decisions. How we do is that we think people have wishes and there is a finance. So whenever they want to spend a bit of money, which is more than a certain amount, they come to our online propositions and we help them, guide them of whether to take this credit or whether to do it via small investment, how would their personal financial balance sheet will hold down to. What we realized was consumers do not buy a product, they actually need an end product, which is either they look to buy a home, and a home loan is an end to mean of that. So in doing that, we constructed this program where we thought, let's help consumers maintain their credit and let them guide them through guide parts of whatever the wishes they have. We figured out consumers and millennials are making a lot of options. They have a lot more desires, and at a point of time, this is reaching to a point where their credit offtakes are higher than actually their incomes are. So that's the proposition that we Wishfin have. We currently have about 14.5 million customers in India. We disperse about 3,000 crores, 300 crores of loan dispersals a month. Of what we want to be, as we want to help consumers take responsible financial credits. That's what keeps me awake all the night, and that's what we work for. Thank you.
Thank you, Rashid. Now, last but not least, Yat.
Hi, everyone. I'm trying to speed up since I'm the last one, and I quickly explain what we do. I'm a company. I'm Yat Chen, by the way. My name is Yat Chen, and I'm personally from Hong Kong, and I work in Shanghai now. We are a fintech company. We founded in 2013, and our main clients are the banks, investment firms, those financial institutions. People ask, why are we starting to deal with financial institutions? To be honest, all these clients are actually from abroad. None of our clients are from China. And what we do is actually we realize that all these financial firms, they have a very rigid, reliable core system, but that is also the problem for them not able to change to a more flexible manner to deal with changes in the ever-changing market. So what we're doing is to help them to bring in technology and designs to bring them closer to their clients in China. For instance, some of our clients are from, for example, Middle East, and they have offices globally, and they would like to come into China. A very obvious reason that they need our help is that, for example, people do WeChat in China. And in the rest of the world, people might rely on Facebook, Twitter, and all these platforms are already in use and supported by their core systems. So what we do is actually integrate their banking system, their financial system, their core backend system into what is capable in reaching their customers in China. For example, integrating that into WeChat, enabling more people from WeChat that represent the majority of populations in China. I read the report is about 92% people having WeChat in China. So I think the number should be higher than that. So this is what we try to help with our customers, to open up their exposures, to reach out their customers in a more friendly and local ways in China. And talking about my vision, I moved to Shanghai like 5 years ago. I remember the first couple of months, I was still using cash whenever I go to restaurant, convenience stores, and even on taxi. But now I think I haven't been touching cash for like 5-6 months now. The last time was that my phone went out of battery. So everyone is using phone for digital payment, making easy payment across the whole city or China. So I think this is what fascinated me. In just 5 years, 4 years time, the country has already evolved from a cash country into, I would say, a confident to say it's a cashless country. And it's actually, the trend is still going on. So we are thinking that, we are actually helping more financial institutions in doing similar ways, enriching their customers in a more simple way by not touching much on their core systems. Because we understand that most of our clients, they are, they're willing to change, but it's many obstacles in making change possible because the core system has been there for a long time. The hierarchies are just there. It would be virtually impossible to make changes in a short term. I'm saying like 1 or 2 years changes. But in a market, in an ever-changing market, 1 or 2 years is already a very long time. So what we're doing to the market and for clients is that we actually provide a quick solution. We're talking about 3 to 6 months, a conversion solutions for them coming into China, acquire customers, maintain their business, and do even better in the future. That's a quick summary of what we do. Thank you.
Thank you, Jan. So let me kick off here, hopefully very lively discussion. We have a very experienced and broadly knowledgeable panel here, as you see, from all across Asia. I will allow myself to pick a few of you for some of the questions that we have shared with you before the panel, and I'm really looking forward now to hear between the different panelists a bit of a debate, because we don't have to agree on everything, so to find also the differences between the different markets. I think this would be something which is most useful for all of us, that we see that Asia is diverse, and the question is, how can Asia manage this diversity and still all work towards the same goal by making life for everyone in Asia still a better life. And I want to start first with addressing who are the unbanked, because when you read reports, you always read about the BOP standing for the bottom of pyramid, or you read about the MSME, which means the micro, small and medium enterprises, but these are all abbreviations and numbers, and finally what we want to see are people, we want to see faces. I mean, who are these people that need to be included with our technology and with a banking system that is more fair and accessible? And I would like to start here first with Adrian, if you can share with us a bit of your very broad portfolio of GoBear companies across the Southeast Asian region, and whether there are any religious differences that you see in mixed markets like Malaysia, where you have competing systems, or whether this is something which is not relevant.
Yeah, I guess fortunately or unfortunately, financial services is in some ways the second oldest profession in the world. I don't think across, in the region there are some Islamic finance products, but the way they work in our supermarket, so to speak, is very similar to other products. I think what I would say is, across the region, in the 7 countries we operate, is there are some similarities. I would put Hong Kong and Singapore to one side as relatively developed markets which have quite a bit of information about the consumers. So I think that's on one side. And then we have markets such as the Philippines, here in Vietnam, Indonesia, to some extent Thailand, Malaysia and so on, where fundamentally a financial supermarket like us struggles because the financial service provider struggles. And what do people struggle in these regions? Fundamentally, people struggle in assessing and pricing risk because of lack of data and information on people. So I think we see this in India, we even see this in China previously. So if you can't assess and price risk, then you can't lend. And that's why you have credit card penetration 3% in Indonesia, 4% in the Philippines, and so on. Similarly, you have insurance penetration at sub-double-digit penetration as well. Similarly, because insurance companies don't know how to assess and price risk. So what we are trying to do at GoBear, obviously for the consumer, we're a bear. So we're fun, trusted brand. We try and provide choices in a supermarket. We try and match products to their needs. But what's more important to do that real match is we are trying to help financial service providers assess and price risk through using alternative data combined with traditional data. Because, as was mentioned, more people have a smartphone in the Philippines or Indonesia than have a bank account. And the bank account is the most basic financial product. A bank account actually makes money, doesn't make money for the bank. And what people really need is access to credit, access to protection, and wealth management tools. So what we're doing is helping people take data from the 30 million visitors, 35 million visitors we get. We take behavioral data, we take demographic data, we can take digital footprints, we can take a number of different data points depending on the country and create a picture of what this person looks like. And we can prove it to the bank or the insurance company, because this is more than just when you're lending out money, you want to get it back. So it's got to be more than a theory. When you give someone insurance, you want to make sure they're not fraudulently claiming on you. So we can prove it through data and statistics, through what we call the Gini coefficient for credit returns. We can show that in terms of claim distributions for insurance. And in that way, GoBear, we are a data company for these providers, where we assess and price risk, we help them create profitable products. There are many, many things on our supermarket shelves that are missing, which if you were to go to the US or Europe would be there. We don't have all the milk, all the eggs, or all the bread. And the last thing that we do, which is the most obvious for most people, is we help banks acquire profitable customers. And I say profitable customers because you need to make a profit. We're not just acquiring leads, because in financial services, unlike other businesses, the person may not be profitable if you lend them money and they don't pay you back, or if you give them an insurance policy and they claim on day 3 and they never meant, they were fraudulent. And I think it's actually a classic technology play where we are providing a better user experience, and we're fundamentally changing the cost structure of the industry. And that's the only way that you can service a person who wants a $100 loan or a $500 loan profitably. So on average in Singapore, the personal loan average balance is 10,000 Singapore dollars. You'd be lucky in Vietnam to be $500. The fixed cost is the same. The only way that you can address this is through technology and data. So that's what we do, and that's what I think is similar across all of the markets. Vietnam, Philippines, Indonesia, Thailand, there is no credit bureau. Many people are in the cash economy. There are no traditional blacklist databases, fraudulent checklists and so on. So you have to create this from scratch. The good news is we don't have to follow the US or Europe. We don't have to, everyone's got a everyone's got one of these, perhaps even two, and we can use this to create, to leapfrog Vietnam here. We can leapfrog straight into 4G, like we see Myanmar. We can leapfrog into creating digital profiles of people that don't exist anywhere else. And that's the similarity and the excitement that I have for developing Asian markets.
This already brings us to the next market of interest, Myanmar. So how does this work there? Because Myanmar is known for having an extremely powerful donation structure when it comes about Buddhist monks, for instance, and donations that you do during the year, particularly at festivals. I mean, is this part of the financial system today, or is this part which is unbanked?
Yes, actually in Asia, I have to say in Asia, if I say among the ASEAN, so Myanmar is the big cash economy now, everywhere in cash. If you have cash, you don't have cash, you cannot do anything. So even if myself, if I come to the Singapore during the last 2 weeks to attend the ASEAN Business and Investment Summit, and also I went to the PHAT, so I got the visa cap program, so which is making from visa in collaboration with one of the biggest bank in Myanmar. But I cannot use in Singapore, and I don't know why, they have error. So this is a signal. They need a lot of the technology development. So people, anyway, everywhere, there's a lot of the cash payment in donation, and every payment, every consumer product, etc. So yes. So what I found is that Myanmar bank, most of the Myanmar bank, they have a lot of the people now. So half of the people, they are busy with the counting cash, not the other banking business. So this is a really human capital intensive now. So for the fintech, what is fintech doing? Fintech doing fintech are really dangerous threat for banking business, right? So that's why. Why is that? Banking is normally banking business. We accept the saving and investment and pen transfer, etc. payment. So insurance business, so lending, so all of the things we are doing by cash, by people, not the technology now. So for the donation, there's nothing technology for the donation. So everybody use the payment by cash. So there are a lot of the wrong for the painters player. For the bank, they have to do something. They cannot run like this in the long term. So the best way is they have to find the partner to collaboration with the painters partner, I think so. The reason is that now in Myanmar, in the outside, competition is so high now. Just the area of the digital wallet, payment, transfer, lending, and so in this area, different people have the different technology, and they are competing each other. So for the traditional bank in Myanmar, they have another problem. Because the traditional banks are normally relying on the legacy system, but in Myanmar, banking system is quite poor now. So central bank, they are most bureaucratic organization in the country. So they have to change the regulation pass to accept this kind of the financial fintech or whatever, etc. pass. So for the Myanmar bank, they have to find to collaborate someone from the outside to tap the technology to run in the in the long run. Yeah.
Good. So, Alexei, if I may ask you, you can really build the bridge between Middle Asia and Southeast Asia. Where do you see the differences between the unbanked when you now have a look at your markets in Kazakhstan or your markets here in the region? How are they different, the ones that are not yet included for financial services? Between the different markets, when you see who is not banked, who is unbanked today in the different markets, are there differences or are these the similar or same group of people or entrepreneurs?
Yeah. Okay. I think before answering the question, and you raised the right thing. You know, let's define who are the unbanked and underbanked. And I think to answer that question, we've got to first think 100 years when the banking system actually just started. And the only three things that banking system does is provide credit, savings, and transfers of money. So these are the three core things that we all use banking services for. And number one in terms of revenues is credit. Credit is the bread and butter for all the financial industry, basically, from my point of view. And so that's where the biggest problem is actually access to credit is where we see the biggest issues across all the markets that I've explored, and we're trying to do business there. So, and I think the problem is really not just trying to meet the needs of the unbanked, because there are a lot of people in the countries that we know they do have a bank account. They have a registration, yet they are kind of digitalized, or they have some footprint in a banking industry. However, having a bank account and not even be able to put there a couple of dollars doesn't make any difference and doesn't bring any value, neither to the customers nor to the banking system. So I think the biggest issue is really in the segment which is underbanked. The people that can have a bank account, can even have a payroll card, or they could go and open a bank account. There are no issues. Like, we are not the US or the UK where you can't even open a bank account unless you put a few $1,000s in it. The bank will not do anything for you. Well, in the countries which we are talking about, the Asian region, you can open a bank account no problem with $1. However, that is not solving any issues. The issue is is the ability of these people to actually access credit. And these are the problems that we as a company and we as a group of entrepreneurs should really focus on tackling. So from my experience, we see hundreds of people that have applied for banking loans through our platforms but have not been able to get a loan approval. And these people could be self-employed. In fact, they could also be employed. They could be the guys who work for government-owned companies, private companies. They're in a, let's talk about the youngsters, the guys who just graduated from the universities or colleges and just got their first job. They could be in a first or second year in their job, and they don't have any credit history. They do have payroll coming into their account. However, there is no way they could get access credit because bank wouldn't. It's like a chicken and egg situation, whereas these people are already credible enough and they get their paychecks on a monthly basis. However, they don't have access to credit. So anything from that customer group to the taxi driver or an Uber driver who is self-employed, who makes money, however doesn't have any credit history and doesn't report that to a credit bureau. So we've worked with a number of different segments, but they have one thing in common: banks don't want them. And it's our job, or it's our mission is to actually make these people, to actually try and convert them from underbanked to bankable, by helping them find the right bank or find the right MFI, a microfinance institution, or find the right online lender to actually build this first credit history with small, tiny steps and build that history to actually become bankable. And that's I think this is a huge opportunity for many fintechs that are in the same space. And the segments, they could be counted in millions, the guys that I'm talking about.
Thank you for that. So we have heard already twice here now how important analytics are, and really coming up with analytics that help to have a finer assessment of someone's credit worthiness, and then open up, of course, a loan for such an applicant. In general, when you have a look at the incumbents, the TechFins and the fintechs, then what we see is incumbents, they have all the clients in the traditional financial services business, but they struggle with innovation. You have fintechs, and the fintechs, they don't have the clients, but they have basically all the brilliant ideas. So between incumbents and fintechs, you see a lot of room for collaboration. Now we have the TechFins, and I think this is probably the most scary type of the three, because they really scare both of the others to death, because they have both. They have the technology, and they also have an existing client base coming from a different service that they have really mastered. So within that scenario, when you see the ones needing probably the least help are the TechFins, and how can then players like fintechs help the incumbents to catch up with the TechFins?
Okay. I think that the characteristic or the DNA of financial companies and fintech companies are very different, right? Financial companies, they like to manage the risk or have lower risk. They want higher profit, and they want stability, less risky business, right? But fintech companies, they are used to fast technology changes, and speed is essential, right? So these two are very different characteristics, and you can say they are complementary to each other. So when banks, they would like to employ fintech to help them to expand their business, right? The best way is not just do it by themselves, but collaborating with the fintech companies, which will help them manage this new technology, new business model, new customer base a lot easier that way. So I have always promoted the collaboration between financial institutes and the fintech companies. The challenge for fintech companies are that financial is it's a highly regulated industry. So for any startups, the barrier for success is much harder than internet companies. So they usually collaborate with the financial institutes to become successful. Yeah, but in some market that may be different. But for example, the earlier time of China, right, the regulation is a lot loose, and so they can move very fast. And so fintech company, the internet company, can grab the opportunity and become large and grab the market from the financial institute. But elsewhere in the world, I think that's very rare. Okay, so and also the maturity of the existing financial service, the infrastructure, the population, the size of the population, the number of banks, all affect the adoption of fintech. And I think for financial service, the more mature in the society, it will be harder for the fintech companies to be successful. And infrastructure, the more advanced infrastructure, they can foster much faster adoption. But on the other hand, technology can be leapfrog. So even though like India, right, their telecom industry may be behind at one time, and now they are very advanced because they can buy the latest technology and leapfrog. So I think fintech is the same. What's interesting is that I think that at the early stage of this adoption, if the market is right, the technology company can move very fast, so they can grab the market. But when the market becomes mature, then the incumbent has the advantage. So for example, like ICOs, right? Technology can grab this market very fast, and last year was the case. But next year, you will see the security tokens, then it's the playfield for the incumbent, right? So the time for the for the fintech company or technology company, it's actually pretty short. So you need to get the, with the speed, get the economy of scale. Otherwise, you will be behind, right? So you need to adapt. Either I work with the financial institute from the beginning, or I need to move very fast to grab that economical scale so we can be successful to stand alone. I think that's probably the challenge for the fintech company. And from the society's perspective, I think fintech promote, right, providing financial service to the unbanked, but not any unbanked, to the trustable unbanks, right? And this trustable definition may not be how much they earn or how much they have, but it may include, their behavior, whether they are responsible or not, whether they can repay or whether they are willing to repay. So those are all new criteria that the traditional credit rating does not consider. Right? In the past, we only consider your wealth and your credit and transaction history. Right? So helping these banks to establish trustable record becomes an important thing in order to promote the fintech services for them. Yeah, because nobody, including the fintech company, can take the high risk and just lend to any unbank. So building those capability and also cheaper, faster, lower barrier, easier to access, these are all key for successful fintech business. And my belief is that if we can link different industry and different financial and fintech company together, this will make the biggest impact and benefit everybody.
So that's a confirmation a bit of the collaborative model. How does it look like in Australia as a rather mature market when it comes to incumbents and fintech also working together? We see a lot of very smart initiatives in the digital space from Australia already for a couple of years. I mean, how does it work, this collaboration?
Yeah, it's interesting. Fintech is a frustrating term in some ways because to different people it means different things. To some people it means managing a superannuation or retirement account. To a stockbroker it means how they transact. To us it means how we manage lending. But it doesn't necessarily mean the same thing to everyone. As Tom said, Australia's got quite a mature market which presents some issues in themselves. The banking landscape is dominated by 4 large banks. One of them is called NAB, which I bank with. I used to say that stands for not a bank. But if they had their druthers, and I would offend anyone here if you're from an Australian bank, but if they had their preference, they would lend to governments, they'd lend to listed public companies, for home loans, and for personal loans and credit cards. And they will all advertise that they support small business, but when it comes to the crunch, they just don't. That sounds fairly negative, but it is the way I see it. We're well into a banking royal commission, as they call it, because there's been complaints for probably 10 years about the conduct of the banks that have been supported by government regulation. And you could say they've become dumb, fat and lazy, and some of the scandals that have been unearthed in the last 12 to 18 months is really quite shocking, where they charge fees for no service provided. They sell in credit insurance where the terms are such that it will never be paid. So whilst most of this conversation has been around the immaturity of banks, I've got to say that when you get to the immaturity in some economies of the banking system, when you get to an extreme legacy system, it can throw up a number of different issues. In terms of what we do, as I touched on earlier, we do trade finance for SMEs. 85% of employment in Australia comes from business, and we would typically be dealing with someone that is unbankable in the traditional sense, not because they're necessarily a bad business, but because they don't have a home that supports the level of borrowing that they need. They don't have real estate that supports the level of borrowing that they need for their business. Separate from our traditional funding activities, where we're sponsoring and funding what we loosely call a fintech, because in our industry it typically takes between 7 and 10 days to onboard a new client. One of the issues we have is that, unlike in a traditional lending model, our first credit risk is not our client. Our first credit risk is our client's customer. And whilst we can get credit information from a credit bureau on our client, we can't get it on his customer. So we're also exploring non-financial data sets to try and underwrite that risk. And our target in that whole project is to be able to onboard inside of 24 hours. It's a pretty ambitious project. We think with where we've got to so far, we can get it down to 3 or 4 days. But with better use of technology, we should be able to get it down to that 24, 48 hours. I'd be interested in knowing more about the different data sets that people use if it's not proprietary information. Adrian made some comments earlier, and I wonder whether they are data points that can only be gotten through one of these, or whether it's other broader data sets that you can access, if it's not proprietary, or to the extent that it's not.
I guess the great thing about data or big data or artificial intelligence is you need a lot of it, right? And it gets better over time. So there are 50,000 data points on your phone, and you combine that with behavioral data, and then you can combine that with demographic and other user-provided data. Ultimately, depending on the country, you can also connect to, you know, in Vietnam, you can connect to certain databases, in Indonesia and so on, in the Philippines. And I think through that you build a picture. But then, I guess for us, we say the data is proprietary, because when you add it all up, I don't think knowing somebody's name, age, or sex, or married or not is not really proprietary, but it's when you add up all of this plus the alternative data sources, then that actually builds a fuller picture. And it has to be proven statistically, mathematically. I think the difficulty for your business is slightly different, is because we are a consumer business, which is a law of large numbers, and it can be an industrialized process. When you do SME, then you're talking about balance sheets and a few other sort of legal structures in the way, which you then have to assess the difference between the SME financing and the personal credit. There is a business in China called Jimu Box, and that also does SME credit, and they were suggesting, Zhou Jing, the CEO, was suggesting they use alternative data for SME financing and found it predictive. I'm not sure what they use, but in China you can get lots of data in many different ways which are not available in other countries.
Yeah, there's some limitations in Western economies. Yeah.
Well, I think in every country outside of China, we can't get that information.
Yeah. Interesting with some of the comments that were made earlier. I've got a colleague in the US who he's got an Amex card, and he also has a merchant facility and receives a lot of payments from Amex. And out of the blue, unsolicited, he gets an offer from them that says, based on your sales and based on your payment conduct, we've pre-approved you for a $100,000 line of credit whenever you want to draw it. Yeah. Just out of the blue. So that sort of conduct, that sort of behaviour is really valuable.
Whenever these statistical functions would happen on large bits of data, there will be branches, or there will be sections of consumers who will be offered this pre-approved offers that you talk about based on certain transactions that they're doing across. See, when it's a primitive in nature, they they have their issues across on that. But primitively, as my friend told, as you have large bits of data on consumers, and consumers have less, and they can be branched into a statistical numbers, you actually figure out a consumer behavior coming out of that sets of people, which you can then lend out to. And it becomes a profitable model over the years also, because as soon as the statistics are able to branch and say, Mr. A is performing like this, he is likely to perform this, and can be proved over a period of time of regression analysis, you can actually achieve that sets of success point through that. So the data may not be very different from the other company. The data, the data points may be 100 or 200 for each same. But however you evolve your technology, however you evolve your statistical and machine learning across on it, will actually define a better product company across on that. So that's the difference. At times, the data points are equivalent to whatever they are using across on that. But after a point, it is how you interpret that data, how you're statistically able to achieve to a certain segment to that data, because there'll be a certain section of consumers who will behave differently on that. So that's the difference across on that.
Very insightful. Let's talk quickly about country and cultural specific customer needs and preferences. And one of these is for me clearly, how do you get your financial services? Because everyone needs payments, everyone needs a credit, and everyone needs some sort of savings component, but in what form? And we have here probably in this group two extremes. We have on the one hand, we have the fully digital Chinese market, and on the other hand, we have a very, very still hybrid model-based, I would say, human interaction, trust-based Philippine market. And Miko, can you share a bit more with us about how this works in your market?
Definitely, the Philippines is sort of the, for a data scientist, it's sort of the dream, right? Because if you really want to tinker with alternative data, Philippines, Indonesia, perhaps Myanmar, and some of the other frontier markets are sort of the places to go. There's a lot. Smartphone penetration is not that high yet. And so you really have to be creative. So in terms of sensor data, we call it sort of what the philosophy we have is that we try to do all source data. So as they said, it's the science and the math, it's all there. Actually, you can go to Kaggle, you can just Google it, and you can get all the models you need. TS Fresh, Scikit-learn, everything's there. You don't even need deep learning. It's all mostly machine learning models. But having access to data is the key success factor. So what we did was, when we started the remittance business, and the beauty about remittance business, and the Philippines obviously is a big remittance market, is that you're required to get KYC from both sender and recipient. So again, getting past the sort of the data privacy rules that are starting to emerge worldwide, not just in the EU and the Western countries, but also in emerging markets, having access to KYC is number one. Number two, transaction data in the absence of, let's say, sensor data from smartphones, which is still very sparse, if you will, is very important for us. So we like transaction data. Remittance, obviously, is something that's recurring. Bills payment also is something recurring. What we did in the Philippines was we partnered with the largest bills payment aggregator in the country. Every month they collect around $220 million worth of bills, and 90% of that is collected in cash over the counter, which is sort of astounding, right? But the habits are very hard to break. So in the meantime, rather than forcing the issue and trying to get them to use a wallet, we just try to work with the over-the-counter companies to acquire the data. So we also are now working with insurance companies to get insurance premium data. It's not quite big yet. Airtime in the Philippines and Indonesia, these are very big prepaid mobile markets. So having access to Pulsa data in Indonesia, or what we call in the Philippines load, in other countries you call it recharge, is also quite indicative. Although I must say, there's you know what we've learned. I'll share with you a little sort of some anecdotes of what we've learned over the past 3 years. For example, we did a pilot, or I can't say, one of our lenders did a pilot by lending to Grab drivers in the Philippines. So Grab drivers, on average, will have a monthly spend on mobile data of 500 pesos. That's roughly $10. Well, the average ARPU of a prepaid customer in the Philippines is roughly 100 pesos or $2. So, you know, I mean, in a way, intuitively, you would think a Grab driver would be a better credit risk, just compared to someone like a normal prepaid mobile user. But in that pilot, when they lent a very small amount to this sort of sample of Grab drivers, 90% defaulted. I don't know the reason why. So sometimes sometimes what we think from a very theoretical, sort of statistical mindset might work, actually doesn't work in real life. Another thing we learned is that, for example, one of a very successful traditional consumer finance company that we work with, they know that when they lend, the first loan is typically paid on time. It's when they start lending on the second loan, that's when the default rates go up. And why is that? So I think there's that element that the borrower, when they're not very financially responsible or mature, will try to get their credit score sort of, as they say, window dress their credit score by doing well in the first loan, but they try to now game the system by, or maybe they tend to get more complacent on the second loan. But the lender will still lend the money, even though they know statistically over a large sample, 15% will default, they will still lend the money. And it's because they realize at the end of the day, it's the cost of acquiring that borrower. So there's little things that you do, and it's this whole alternative data which forces us in emerging markets to be very creative at the same time, really use sort of technology to glean. One of the basic questions is, how do you differentiate between correlation and causation, right? So a lot of things that are statistical may not actually work in terms of predicting future behavior. So I think the key really is to have that mindset of gathering as much information as you can. Getting 50,000 data points from a smartphone is excellent. And then at the same time, layering that with all the other different paper points you can get to paint the picture is probably the only way now to do it. So the good news is the technology is there, and as the economies become more digital, as more people have smartphones, it's going to be a little easier to acquire that sensor data. But at the end of the day, it's still that sort of how do you mash it up? How do you put it together in an ensemble network, and to figure out. And then at the end of the day, you also have to in effect, and I noticed this with a lot of the fintechs that have been operating in the Philippines, from China, from Kazakhstan, from Russia, is that basically they try to throw money out the window and basically lend, let's say, $100, $200, just to see what happens, and that's when they build their risk model out of. It's a little bit brute force, but that seems to be what works now. But I think eventually people will be more nuanced as people become more, how do you say, change the behavior, things will start to changing. So the key really is to get to persevere. I think it will take maybe between 3 to 5 years to really have a very sort of a robust risk model for across a very large sample. And one thing though I've learned is that when you work with the traditional lenders, many of them have historical data sets that they've not mined very successfully, because many of them are still using legacy databases like Foxbase or FoxPro. You'll be amazed. Some of the largest consumer finance companies in the Philippines are still using DOS or some weird legacy database product or loan management system, and they have no talent nor resources to actually mine that data, but that data is very rich. So we've been working with some of these traditional lenders to see how we can mine their data and actually aggregate that data, anonymize it, at the same time aggregate it with other lenders to come up with a much more smarter or much more insightful sort of system across a large sample set. So many of the lenders have this sense that, oh, I have this secret sauce, I know already how I lend successfully, but they're beginning to realize that by merging their data with the data of other lenders, you're actually coming out with better insight, because as the law of large numbers will actually work on your behalf. So so these are the little things we're doing in the Philippines. I still think it's early days, but I think the sort of the innovation and sort of the insights are actually growing exponentially over even in the next few quarters.
Thank you. Yat, do you have something to add? Because you're the ones here dancing with the wolves when we see that you integrate incumbents and other companies with the likes like WeChat. So how do you see the more advanced Chinese market dealing with these scenarios?
And first of all, thank you for Miko. He mentioned a couple of keywords that actually draw my attention on thinking about my work. And first of all, in my daily work, we talk to institutions and we face the same problem, that they have a very rigid mindset that has been working for years, whatever the way of their practice, the system they already have. So what we normally do is to actually have a session with them, talk them through, see the pain point. And basically what we have now is trying to adopt what we call a more open banking solutions into our products and services to our clients. For example, some of our works require us to build up onboarding systems for our clients. So enabling customers in China to access their database through, for example, WeChat in this instance. So again, this requires some sort of a discussion with their management, because people concerned about data collections, especially from channels outside their available core system channels. So what we're doing now is to, first of all, explain to them what we are doing by integrating different sources. For example, KYC, we do KYC in the middle of the process to making sure that these are the customers are required and qualified to be the customers. For example, age, job status, income, etc. So we actually outsource these KYC services to external vendors by putting APIs like connections. So enabling our systems to be flexibly connected to different service providers in order to provide all-in-one solutions to our customers. And I very agree of the point that people need time to change behaviors, because that's what we do most before we kick off projects and kick off actually productions. Because most of the time we spend talking to the clients are actually trying to pinpoint the pain point of what they have. They normally have the pain point of the core systems, and they want to build a better user experience. But how to do that is very difficult for them to change. First of all, they don't have the team and they don't have the power. For them, it might be a small part of work, but for the exact same reasons, they don't have the resources on doing that small changes. So companies like us provide solutions for them. But again, it is a long process for them to making sure that the key process like KYCs, data privacies are properly handled before we can actually do integrations in a flexible manner. So, so far we have been able to work with clients and with different partners to provide flexible solutions. And I think in the future we would be able to focus more, again, on the directions of open banking, enabling more different partners to take place in different sectors throughout the process, enable a more powerful solutions to be delivered to our clients. Now we're only focusing on bankings and financial institutions, but I think this is a trend that more different areas would be needed. For example, supply chains or other different kind of industry would be benefit in applying this open banking concept, so that different areas can be provided by different professions in making sure the system are delivered in a better manner.
Thank you very much for this. We are already very much advanced in time, so I want to open up to the audience some room for questions. Do we have any questions from the audience to the panel? I think we get very close to the evening program, so maybe the excitement for questions is not there. Okay, then let me ask now a question to the panel for closing, and this is: where do you see in your area of responsibility, in your area of business, where do you see the biggest advancement for inclusive banking in the next 2 years? And I would start again with you, Yat. Only very few words, please.
Right. I think inclusive banking is a trend, obviously, for many countries. At the moment, we're actually expanding to Southeast Asia. We're thinking that with our experience in China, we're actually able to copy and paste similar experience, applying into Southeast Asia countries. Of course, there would be cultural difference, there would be religious difference, but we're thinking that, oh, this is the direction, and we are able to, again, work with our partners to bring more insightful solutions to the regions. Obviously, that will be involving in working with local partners in the long run. But definitely, this is the opportunity, and given to the fact that there's a lot of populations in Southeast Asia with unbanked, the people are still unbanked populations. So there is a need for more diversified digital solutions to be promoted into the areas to help those with a more simple and cost-effective ways in dealing with their money and dealing with their banking needs.
Thank
Yeah.
you. Rashi?
Thank you.
Yeah. So see, what we look at it is in India, we see that India had the highest number of branches in the world, but still the financial inclusion didn't happen across on that. There were two aspects of it. A, the cost for the bank to acquire a customer was still high, and because the accessing to a bank branch, the cost was still high across on that. So we believe as the mobile phone came in, and with the products that you are trying to enable for a customer by having its sets of data, you are able to give him some freebies which he takes, and then the product becomes both viable for the bank and the customers across on that point in time. For an example, you have to see that even government of India started something called as a free bank account, as a Jan Dhan account. He had 300 million people accessing or opening an account with that. But you look at it at that same point of time, at Wishfin, what we are trying to do is, at any time you're making certain purchases, we are trying to say that you can round it off and invest, it can invest to some of your wishes across on them. So what we believe is, if the product becomes good enough for a consumer, he opts in himself, he understands, learns the technology and goes for it. And as soon as you have a product that does it for them, so the adaptation and dependency on certain things are not there, the cost gets reduced because you don't have to market that product. So somewhere, somehow we are trying to actually access this problem in that way.
Thank you. Koyang?
I believe that financial is actually the vessel for the whole industry. So it actually affected by the industry changes. And in manufacturing, we are seeing Industrial 4.0. And the key aspect of Industry 4.0 is the change from supply chain to value chain, value networks, right? So I think that will affect how financial service is provided to the industry. Similarly, the companies are become omni-channel, right? So from that perspective, even your customers become part of your sales network, delivery network, your design network, etc. Right? Demand-driven, human-centric. So from that perspective, the financial service provider need to think about how do we integrate into this different new model of the business and new model of the commerce to increase the financial liquidity and flow so that we can provide higher value and also lower the barrier at the same time. So the information that you collect in that integration will be a significant help to help lower the barriers. And so from this perspective, I also think that cross-industry and cross-domain integration is a key. And that's why we focus very much on the technology integration of different financial aspects and the data and analytics of these different industries.
Okay.
Thank you.
Alexei, your predictions for the next 2 years, biggest advancement for inclusive banking?
Well, I'm going to quote the report that I came across a couple of years ago. It was produced by Accenture, and it's called 1 Billion Reasons to Bank Inclusively. And what these guys are saying in this report is that there is a 300. It's a report that covers all over all emerging markets. So according to them, there is a 380 billion revenue opportunity on the table. That's an annual revenues that could be generated additionally by the banks in the emerging markets. Approximately half of that would be generated in that region. And the 4 segments that they've identified that would likely make more money for the banks, these are micropreneurs, SMEs, low income, and mass market consumer segments. And how much of that would be generated by the fintechs remains to be seen.
Thank you. Tom?
The WEF data is much higher than that. The emerging market opportunity gap is $2.3 trillion, according to WEF 2015 report. Yeah, so that's a great opportunity for SME.
Any points from your side for the next 2 years?
Next 2 years, yes.
Microphone, please.
According to the most of the industry nature, so in some way, in some point, you have to have the consolidations. So I think so most of the banking bank will be consolidated somewhere, and so bank will be merged, the small and big, and then for the fintech technology player, they also have to have the similar merger and acquisition to be consolidated over the industry. That is my perspective. Yeah.
Consolidation. So we come to Kimball. Very few words, please.
Yeah, very brief. And I can't comment about emerging markets, but in Australia, hopefully a democratisation and more openness in banking and more competition would be what I see as the opportunities. The risks could be government regulation, poorly designed government regulation got us into this concentration of power in our banking system. And if they don't get the regulations properly balanced going forward, we'll get a repeat of the same thing.
Great, that was brief and to the point. Miko?
For me, I'm very excited about basically this convergence between what I call the emerging middle class and capital and financial services, as well as technology. The technology's there, the capital's there. In the Philippines, there's like $150 billion sitting in cash accounts in big banks. That's just the Philippines. In Indonesia, when I talk to the banks, they say their loan to deposit ratio is actually at 30%. Basically, the banks are flush with cash, and that doesn't even include the Chinese, the Japanese who want to deploy their capital, even the European banking companies. So there's a huge amount of capital, and there's a growing middle class. I think the four segments that you've identified earlier, which is basically the middle class. So this is where the action will be in the next 5 years. Southeast Asia, I think, still is the most exciting region in the world. You got basically over 500 million people who are just entering that stage in their in their life cycle where they're going to start buying cars, homes, paying for insurance for their children and for their education, and also so on and so forth. So the real problem now is there's not enough talent to actually put all these little things together so that the financial service companies, whether they're the incumbents or the challengers, can reach this middle class. So, and I see it because the average lending rate in the Philippines for consumer finance is still at like 6% per month. So that basically tells me that the right amount of capital is not reaching the right borrowers yet. So there's a lot of stuff to be done, and I think technology and sort of smarts will actually bridge that gap.
Good. Thank you. So technology and shortage of talents. Last but not least, Adrian, please.
So in terms of the opportunity for all of us will be for the mass market. And the middle class, as Miko said. So it's not necessarily the bottom 10%, but I think it's the middle class, the 50th to 90th percentile who are severely underserved. I think that is the huge opportunity. I think the big game changers will be data, technology to reduce costs and improve experience, and frankly, new business models, right? Not just traditional banking. And then I guess what I see is lots of capital sitting in reinsurers. I see lots of capital in alternative institutions, whether it's hedge funds or other pockets of capital. And my prediction is that this opportunity will be captured, and it will not be captured by the incumbents. Not at the pace that I see, not because of their regulations or their interpretation of regulations. So I do see that this large pool will be captured mainly by alternative companies who have usually come from a tech background, like and financial, Tencent. Amazon's getting into financial services. Facebook will start already doing payments, peer-to-peer payments. So I think we will see that's the change. And then I think the other company that will be doing that will be GoBear. That's my hope.
A wonderful statement to close here. So we see it's really the age also of the tech fins, not only in China but also in Southeast Asia. So dear audience, please help me to put our hands together for a wonderful panel. We have learned today a lot about their day-to-day work. It's not easy. There's no magic sauce, no secret sauce for making financial inclusion happen, but all these panelists here have demonstrated today how hard and innovative they are working every day to make this happen. And so this deserves our applause, big applause for this wonderful panel. Thank you.